Welcome back to the Property Trio podcast, the podcast for the sophisticated property buyer. Today we're diving into one of the most misunderstood concepts in Australian property investing, negative gearing. Whether you're a seasoned investor, just dipping your toes in, or plan to invest in the future, this episode is essential listening. Let's start from the beginning. Dave, in plain English, what is negative gearing?
So, Cate, negative gearing simply means that the expenses from holding the property are greater than the rental income that you generate from the tenant who rents the property from you. So, basically, in simple terms, it means you are running at a cash flow loss with your investment property as things stand currently. So, what happens is you then get to deduct this loss from your taxable income. And obviously the idea over time that the property's rental income and value growth will outweigh the short-term cash flow loss. So a quick example of how this sort of looks when you're in inverted brackets negative gearing. Let's say your property generates you $40,000 in rental income per annum, but your total cost, which will cover what they make up, the tax deductible costs in a second, let's say the total cost to hold and run that property is $50,000. Then this results in a $10,000 cash flow loss to you. As the owner of that investment property, you need to come up with an extra $10,000 of your own hard-earned to cover that shortfall. So let's say last year you earned $150,000 a year in your salary, and then you're able to actually deduct that $10,000 loss if the property is owned in your personal name, and you're then only paying income on paying tax on an income of $140,000. So this would mean you are in the 37 cents in the dollar tax bracket, so you'd be entitled to a refund of $3,700 of tax. But that means you're still, even though you're able to claim that loss of $10,000, you only get $3,700 of it back. Let's be clear on that. So you are still out of pocket $6,300 across the year.
Okay, Mike, I'm going to circle back to you as our resident tax expert. What are the costs that an investor pays for? Sorry, let me start that again. Mark, I'm going to circle back to you as our resident tax expert. What are the costs that an investor pays for to run an investment property that are deductible?
Yeah, look, I'll try and start I think order from biggest to smallest. The biggest one is normally the interest component on your loan. And that's something that the ATO talks about quite regularly, because if you revalue an investment property and you pull some equity out to buy a Lamborghini, sometimes people claim that loan as a tax deduction, but of course it's not for an income producing purpose, so you've got to be careful. But yeah, the interest component.
What about if you're driving your Lamborghini to go and do tax depreciation schedules?
I don't know if you've been following me around, Dave, but I really think that level of pizzazz, helps the deductions. No, I don't think there's any way to make that tax deductible. That's not reasonable. Probably the second biggest one, I think, is probably tax depreciation. Of course, depending on the property, on average, our data, of course, it changes day to day, but it's normally in the $9,000 mark per year in the first year of deductions, and we can go into a bit more detail about that. Property management fees are a bigger one. Repairs and maintenance can be big depending on the type of property that you've got. Hopefully you don't suffer from that too much. You've got insurance, legals, council rates, those sorts of things, like everything that you can reasonably think about having a cost incurred for even a PPOR. It's just that with an investment property, there are deductible things that aren't deductible on your PPOR.
Land tax?
Yeah, well, land tax. I mean,
I love that
all
one.
about that downstairs.
Yeah, I love that you can claim your land tax.
Yeah.
I hate land tax.
The funny thing is like when one commentator was talking about like land tax and said it's interesting that it's federally tax deductible, but it's a cost at the state level. So in a way, it's the states stealing from the government, which I thought was very interesting.
They're robbing Peter to pay Paul.
They
I guess
just don't
what else
consider
can you do if you
themselves in
think you're...
Paul's family, so they don't mind doing that.
Yeah, yeah. Yeah, so those are probably the big ones. Did you want a bit more meat on the bones for the tax depreciation?
Yes, please.
Yeah, there's what I like to call kind of two buckets of tax depreciation, and they're defined under the Income Tax Assessment Act of 1997. This is why I'm so popular at parties. It's Division 40 and Division 43. So Division 40 is the plant and equipment items. Division 43 is kind of the structure of the dwelling. Now, Division 40 changed when ScoMo made his budget speech at 7:30 on the 9th of May 2017. That'll be burnt into my memory forever. But the capital allowances for the structure, they haven't changed. But essentially, we're just talking about the fact that if you own an investment property, in the course of owning it and having someone in it, they will wear it out. Now, there's no assessment of, okay, well, Dave's a bit of a harder tenant than Cate, so you get more deductions if you've got a Dave in your property than Cate. The statutory rates of the decline in value of the assets. So those are the two components. The plant and equipment, which are like the loose things like carpets, blinds, kitchen appliances, and they all have different effective lives. For example, a hot water system could be 12 or 15 years, depending on the type. Carpet has an 8-year effective life. And then there's the structure. Things like concrete, timber, gyprock, tiling, cabinetry, they just have a flat 2.5% depreciation rate based on their value each year.
Wow. Okay. Well, that is why you're popular at parties, but thank you. Because a lot of people get those two classes a little bit mixed up at tax time. Now, Dave, property investing often gets a bad rap in the media, especially when it comes to negative gearing. Some people might think that claiming the cash flow loss on an investment property is a unique benefit reserved only for property investors. Is that true?
Yeah, look, this is one of the misnomers about negative gearing, as if it's something that's only available to property investors, but that's not actually true. So you're able to claim cash flow losses in exactly the same way if you invest in shares, a business, or a commercial property. So if your investment's cash flow, whether that's dividends from shares, income from a business, or rent from a commercial property, is less than the interest and other holding costs that you're able to deduct for a residential property. Mike's just covered off on what many of those are. You can claim that cash flow loss against your taxable income. So we also need to remember that mum and dad investors are spending hundreds of thousands of dollars to provide accommodation for about 3 out of 10 Australians. And that's accommodation that the government simply doesn't and cannot provide. So according to data from the Australian Taxation Office for the 2020-21 financial year, approximately 20% of Australia's 11.4 million taxpayers owned an investment property. And this equates to about 2.24 million taxpayers who own an investment, which is about 1 in 5. 20% is 1 in 5 for those who
Well done.
can't do the sums in the head. The majority of these investors, around slightly over 70%, only own one investment property. And then approximately 19% own two. So in short, 9 out of 10 investors own two or less. So, these aren't people on, as I touched on before, most people earn between about 45 and 120K who own investment properties. These are mums and dads trying to get ahead. They're mums and dads who are providing and running essentially a little business of rental accommodation, which they provide to people to live from. And they're not, the super wealthy as Mike sort of touched on at the start of the episode. So, less than 1% of property investors own 6 or more properties.
Now, let's put that in
Yeah,
perspective. That's less than 20,000 people. Out of
yeah,
all of the Australians out there that are into investing, less than 20,000 people have 6 or more properties.
yeah. So it's a pretty small select group of people, isn't it? It's not,
Yeah.
there isn't. It's the vast majority of property investors are not the mega rich, and they don't own heaps of properties.
Yeah,
They're
nicely
mostly middle
said.
income mums and dads.
It's also worth noting that every property investor with a positively geared property is contributing billions of dollars in taxes to the Australian government. We can't get away from that. Your property's either negatively geared or it's neutral, and a neutral doesn't last for very long, we know that, or it's positive. When it's positive, you're paying tax on that gain.
Yeah, this often isn't mentioned in the media articles demonising the property investors, is it, Kate?
Yeah, absolutely.
So yeah, that's right. Look, if negative gearing losses couldn't be claimed against a person's income, so let's say some government in power decided to end negative gearing. Like if those losses can't be claimed, what generally happens if you have some sort of asset class where you cannot claim the loss against your income? They're allowed to be carried forward. So that can happen in trusts, for example. So what that means is those losses just accumulate on the balance sheet, and then at some point in time, when that, in this case, investment property starts becoming positively geared, well, then you don't have to pay tax on that positive income you're earning from the investment property, because it's the offset. You're able to offset it against the losses you incurred through the early years of owning that asset. So basically, this means billions of dollars in income that the taxation office has been receiving would be offset by earlier cash flow losses, and ultimately, this actual change in policy would reduce the tax payments to the ATO and the government over time.
That's an interesting one. Let's break that down again for any of the people that couldn't do that complex maths that you were sharing before, Dave. If we ban negative gearing, we're going to take pressure off the budget because there'll be less deductions claimed, there'll be more tax payable. But if we do get rid of negative gearing, then those losses will just kind of sit there cauterized in time, waiting for future gains. And really, every investment property normally will become positive eventually, right? As the rents go up, and even if the interest only stays the same, eventually it'll be positively geared. But those losses will kind of sit there until those triggers happen, and there'll be no future taxes. So it's really just kind of like a timing thing.
Yeah, the phrase you said before comes to mind about land tax. It's robbing Peter to pay Paul.
Mm.
So yeah, look, I mean, this is often overlooked in the negative gearing debate. Yes, there are people claiming losses on negative, and the phrase used is negative gearing. But you can negative gear shares. You can run a business at a loss. You can negative gear a commercial property. At the end of the day, it's just a phrase. What it means is your investment is running at a loss, which then you're able to claim because you've got to come up with the cash to cover that loss. So, yeah, you could argue that one of the reasons we're struggling to build new properties is because many people are concerned actually that they won't get long-term tax deductions, largely due to the scare tactics, certain political parties taking this banning of negative gearing reforms to elections. And that probably is playing some role in stopping people buying investment properties. But look, we won't name names in terms of the political parties who
I don't think we have to. But people just want certainty, don't they? And I think you're right. Like, people talk about negative gearing as a property exclusive thing, but it's not a property exclusive thing. Any real investment, whether that be, as you say, a commercial property or your own business, or big business, like we hear about, oh, this particular mining company, is worth however many billions, and it didn't pay any tax in this financial year. Well, if they spend a year exploring new areas, or they have huge expenditure getting a mine up and running, well, they could actually make a loss that financial year. So there isn't actually tax payable. And I take issue with the people that say like it's a loophole. Like a loophole is something that is you can chance upon. It's not really supposed to be there, and you can take advantage of it until they close it. As far as I'm aware, and as far as anyone has been able to share with me, negative gearing came in and around about 1936. So
It
just
was a
by the
long,
length
long
of
time ago.
time,
Yeah.
that sort of discounts it as a loophole.
Yeah.
Yeah, I would agree. Now, Mike, why would anyone want to buy something that loses the money each year?
That's a really good question, and something that like I used to present a lot to property managers and say, well, what does the tax depreciation schedule actually do? Because they're out there, having to have conversations with landlords, and I kind of thought, this doesn't make sense. Why would you buy an investment property if it just loses money? Like I have to explain to people what the advantages of that are. But the idea is that, let's say we have an investment property and it's costing $10,000 a year to hold on to because the expenses are more than the rent. And that's a very, very common position. You buy any investment property for a reasonable amount of money that normal people would spend really anywhere in Australia. It's probably going to cost you money to hold on to. So why do you want to lose money? Well, there would be people that say, well, I want to lose money because that reduces my personal taxable income because I bought the property in my own name. So that's the payoff. But that's still not good enough. Like, you have to lose money to claim negative gearing deductions. So the only reason that you would do it is because you are securing an asset that grows in value over time. So it might cost you $10,000 a year to hold on to, but if that area is growing at 6 or 7% per year, it might be on paper getting you $90,000 a year. So you can't actually access that money. You have to service it to hold it, but you're building that equity. So on paper, you are actually making money.
Yeah, great answer. Dave, can you explain how a property might become positively geared over time, meaning you're now earning positive cash flow?
Yeah, so look, that's the other side of the coin. Obviously, capital growth is often the main driver of why people get into investing in residential property. But the other aspect is you do want it to become positive cash flow over time. So, over time, several factors naturally work in your favour. First, rental income tends to rise relatively in line with the capital growth rate or inflation, particularly if you've chosen a location with strong livability and ongoing tenant demand. At the same time, and this can be forgotten at the sort of moment in time of people purchasing property or investing, but your loan repayments are typically going to remain relatively stable and potentially even decrease over time if you're making principal and interest repayments. So you've got a stagnant or static uh, key element of your holding costs of your investment property often, which is the interest on the loan, but you're getting capital growth and your rent is increasing over time so that debt or the interest payable on that becomes proportionally smaller and smaller as that compound growth kicks into gear over the years.
So the rent should surpass your holding costs at some point.
Yeah, that's exactly right. Now, how long this is going to take will depend on the moment in the cycle you've purchased the property, how strong the capital growth is, and then how strong therefore the rental growth is in line with the capital growth of that property. So it'll also depend on how much you borrow of that property. If you borrow the full 100% of the cost of the property plus stamp duty and other purchasing costs, it's going to take you a bit longer to become positively geared than if you actually put down some of your own cash and only, let's say, borrowed 80% of the investment property. So, that's why it might take 5 years, it might take 10 years. We've even seen examples where it can take longer to become positively geared. But, a well-chosen property that appreciates in value certainly gives you the ability to borrow against it as well. So that's another advantage of selecting a well-chosen property, and then you can leverage your investment for further investment opportunities. And obviously you get the opportunity to pay off your debt over time, which which can speed up the pathway to positive, having your asset providing you with positive cash flow.
Yeah. So, how do investors make sure that a negative gearing strategy works in their favour?
Look, like with anything, like we talk about regularly on the podcast, you need to have a long-term plan in place. Define what your property plan is, define the goals you're aiming to achieve from property, ideally over your lifetime and until retirement, and, have a plan for when you'd like to retire and when you'd like to scale back employment. You need to understand your cash flow today. You need to ensure you have adequate savings and cash flow buffers after you settle on the property. Review your mortgage structure, make sure you're maximizing all your tax deductions there and got all the bits and pieces of your mortgage strategy working in your favor that you can. Then from there, you're able to choose a price point that aligns with your personal financial circumstances and goals. And remember really that tax benefits are a bonus, but they're not the primary reason to invest. Again, one of these misnomers that's put out there in the media. You don't invest just for the sake of negative gearing. Negative gearing isn't a strategy on its own. And to put in simple terms, I mean, negative gearing is giving someone $1 to get your tax bracket back. So, you're giving someone $1 to get, if you're in the highest tax bracket, 47 cents back in return. Or if you're in a lower tax bracket, potentially 30 cents back in return. That ain't a good investment strategy on its own.
It's mad when you put it like that, right? But people hate tax so much that they're willing to overlook the very simple mathematics of something like that. I mean, I've had a lot of conversations with accountants where they have a client come in and they say, I need to get an investment property. And the accountant says, oh yeah, why is that? They said, because I'm paying too much tax. And they're like, is that the only reason? Like, do you want it to be like a good investment property? Do you want it to grow in value? Like that all comes second to the, no. I just need something that loses money, so I pay more tax. And being in a tax payable position is evidence that you've won. You are doing a good thing. You are achieving something, right? If your business has a tax bill, it's because it made money. If you have a tax bill, it's because you made money. Of course, you want to reduce that, but not just reduce it for reducing its sake. The only way that you want to lose money in the short term is because it pays a dividend in the back end.
Absolutely.
And that actually feeds into one of the other misnomers of the property market, doesn't it? That all properties rise in value at the same rate.
Yeah. I think we did that a couple episodes ago.
I've got a question for you, Dave. That's one of my, I want to say favourites, but it's one of my pet hates because I'm picturing an accountant in someone's ear here. What's one of the biggest mistakes you see people make with negative gearing?
Yeah, so look, basically, as Mike sort of just elucidated to some degree, chasing tax deductions instead of growth. So too often investors are sold shiny new builds with big depreciation benefits and told it's cheap to hold. And look, I don't want to be lambasting accountants here, but some of my earliest memories as a mortgage broker were we worked with a lot of doctors coming to me. Their accountant told them they need to reduce their income, and then their accountant was also introducing them to some developers and some new shiny properties to buy because they offered such great depreciation benefits.
Yeah.
But as we know, those properties are likely to underperform over time, and it only works if the asset itself is doing the heavy lifting by growing in value, and that generally will mean they're going to outperform in growth in rental income as well. And so, unfortunately, spruikers take advantage of that misunderstanding. And then there are people who just don't understand how property operates. And so they're well-meaning, but they direct people to the wrong types of properties. So,
Yeah. It's that saving tax thing, though, that this
it's
decision that people make to save tax. So what, you want to lose $1 and get back 47 cents just because your accountant told you that you need to save some tax. And it's such a difficult concept for some people to grasp. And you've just said it, typically when they're buying this new shiny thing that has the highest rates of depreciation, they're not only losing money to hold this useless thing, but sometimes they go backwards in value. So they're creating a worse off overall financial picture for themselves by following this blind advice. And I remember saying, I actually argued with someone's accountant because they had the capacity to buy something good and they were being told to buy something new and off the plan. And so I contacted the accountant because I asked me to. It was difficult for this client having two trusted people in their ear.
Yeah.
And I said to the accountant, this doesn't make any sense. And he said, Cate, my job is to save them tax. And I said, no, your job is to help make them wealthy.
Yeah. And sadly that happens too often, and that these are often they're well-meaning accountants, and there are financial planners as well but look, too often there are also financial planners, accountants, mortgage brokers who don't understand how property operates, and they're also getting kickbacks from the developers to actually introduce their clients to these types of properties, and then they're getting pretty big, double figure thousands of dollars of payments if their clients purchase these properties. So that's another layer to this. But some are well-meaning and they just don't understand. They're setting them the wrong direction. And for our listeners, if you want, we won't unpack this too much more in this episode, but if you want to understand what we're talking about here in more detail, go back and listen to episode number 16, Unpacking Land to Asset Ratio, episode 58, Off the Plan Purchases, Everything You Need to Know, Part 1, Purchase Through to Settlement, and episode 59, Off the Plan Purchases, Everything You Need to Know, Part 2, The Financial Drivers. And another one is episode 303, Avoiding Property Investment Traps, Off the Plan Risks, Market Timing, and Spotting Property Spruikers. And look, if just to build on that, go back and listen to our first 50 episodes and go from there, because you'll get a lot of the foundational learning that goes into particularly, what makes a good investment property and in strategy.
Oh, that's great. We've banked up a lot of EPs in the library, haven't we?
Yeah, what are we up to now?
I can tell you, 319.
Yeah, and Mike's he's up to but he's been with us 60% of the time, I reckon now, that Peter was. It won't be long before,
Yeah, so you've got more runs on the
reps
board,
up
Mike.
Under the belt. Time flies while you're having fun.
And we're sitting on close to 600,000 downloads. It's been a really special journey. Here's me going down memory lane. I'll channel back to the question. Dave, that old "it pays for itself" pitch from spruikers and salespeople flogging new property. We hear that all the time. Mike, what risks should investors watch out for?
Well, I think it's interesting, Dave's sort of talking about, even in your story, Cate, you're talking about the accountant is trying to save them tax. You can understand going to an accountant one year and, say, getting a couple of grand tax bill, then going to another accountant the next year and getting a tax return of, $10,000 because you've got negative gearing in the mix and you were paying the same amount of tax and thinking that that's actually a positive outcome. But when you overlay it with that, okay, well, what's my wealth position and my wealth trajectory? It can be very, very different. I always sort of say with tax depreciation, it's a benefit, not a strategy. And the tax position is just a result of the structuring. But I've talked about this before. It's like the carrot and the stick. As human beings, I think our psychology dictates that we disproportionately fear the stick more than we go for the carrot. And taxes are something that people hate. There's all the old kind of adages, there's two things certain, death and taxes. And you go back and you even watch, some of those, 800 AD sort of English shows, and it's the tax collectors, and we've just got all these nasty connotations with tax, and I think it's wired into us to try and avoid it. But the risks are that if and I've said this before, if the property investment is mentioning tax depreciation as a benefit, that's a red flag, because it kind of says, well, there's nothing really else good about it. Tax depreciation, typically you won't see an established property with an agent talking about tax depreciation. I kind of think that they should, but they don't. It's typically the new ones because they are typically higher with the deductions, but also because that's the mindset of someone that wants to buy something off the plan. It's a tax minimization strategy. But as Dave said, there's kickbacks in the industry. As you said, these properties can actually be revalued and be less than the cost. So there's just so much evidence to say that established property outperforms, and established property is typically not where the spruiker lives. They typically live in the brand new stuff. And I know lots of people that hopefully aren't listening to me say what I said before, that work in the new space. Not everyone is bad, but that's where the bad actors typically exist in property.
Yeah. Yeah, the commissions are higher and you can, hide the sales data more effectively. There's so many reasons why it attracts, some not so great people, unfortunately. Now, what about neutral or positive gearing? What does that mean? And shouldn't people be looking to be neutrally or positively geared from the start?
Oh, look, I think no. I mean, it depends on the strategy. If you've gone and you've had a catch up with Dave, and he sort of said, look, your goals are to expand the portfolio. You really need high cash flow in the next investment property, or you're tapped out. I mean, that is probably an example of where aiming for a tax outcome is sort of part of the strategy. But in general terms, like whether it's slightly negative, whether it's neutral, whether it's positive, doesn't really matter if you've got the ability to cover that shortfall. What's more important is the prospects of that property. But neutral gearing is just essentially a tax outcome that says your income matches your costs. So I'm not making money from a tax position, I'm not losing money from a tax position. Positive is just the fact that the income is exceeding the cost. So let's say you bought that investment property and you were getting $500 a week in rent, but all up, everything was costing you $600. Now, if that rent goes to $700 after a couple of years, well, then you're positively geared. It sounds ideal, and over time, many properties can increase. However, in the early stages with high growth assets, or assets that are the type of assets that we would all recommend, they typically will be negatively geared depending on the economic cycle. If interest rates were at 1%, your average property would probably be positively geared. But over the long term, typically your first purchase, or anytime you purchase an investment property, it will be negatively geared.
Yeah, so basically, I mean, just to build on that a little bit further, given interest rates, for example, at the moment are around 6%, and let's say your holding costs that you're able to claim are around 1.5% of the property's value, you'd need a rental yield of 7.5% to achieve positive gearing. So the reality is that's very, very difficult to achieve. The average rental yield in Australia's capital cities is 3.5%. So you're significantly short. And even in the regional areas, it's 4.4%. If you look at the highest capital cities average yield, which is Darwin, which is around 6.6%, you're still falling short of being positively geared from day one. And look, there are significant risks in some of maybe the rare examples of residential properties that might have a rental yield of above 7.5%. There are going to be reasons for that. And generally, they're linked to the value of the property being pretty low, not having grown in value for a long period of time, and unlikely to do so in the future. And that's why the yield is so high. And often what can happen, and people are sold on these ideas, and often with new property as well, where someone can paint a picture of how, thanks to depreciation, they'll be neutrally geared from day one. The problem is you're often in that same position about 5 years, and we've all seen circumstances of even up to 10 years later where the property hasn't grown in value, the rent hasn't really grown in value. If you're relying on depreciation, then often the depreciation will have reduced significantly. And the problem is you're in the same position many years down the track as you were at day one. So without unpacking that in too much more detail, although Cate, you actually can unpack that further. if you like.
Yeah, I'd love to. It's wonderful to see the data, the figures in front of us, and you've talked about current interest rates and holding costs, etc. I will make note that for a tiny little sliver of time there after COVID, we had a lot of investors having neutral or positively yielding properties because we had interest rates at 2%. But I can speak from experience and say still with the holding costs, not everything was positive. So if we're looking objectively at this and not banking on interest rates at 2%, which is not a smart thing to do because they were emergency rates, and I doubt we'll ever see them again unless something colossal and horrible happens to the world. We need to be working off more sensible interest rates. And some people would argue that 6% is the equilibrium, even if we wind it back to 5. To your point, Dave, there's not many capital cities or regional centres that are delivering that as a median value. And so the clever ways, which I think can be real headachy ways as well, but the ways that investors can try and get more rental yield include taking more risks and going into areas that have a lot of volatility. So I'm thinking out loud here, mining towns, where all of a sudden you've got an explosion of work, you've got lots of workers, and until they sort out FIFO and little huts and dongas, those investors might get lucky. And then what happens when the mine finishes or the funding stops or all of the FIFO workers get accommodation on site? So that's what I would call a volatile asset. And we could talk to countless numbers of Australians who have lost money and don't speak glowingly about targeting mining sites as investments. And it's not something that I recommend either. I think any volatile asset is a big gamble, and risk and return, they go hand in hand. Other ways that I've seen investors try and bolster their rental yield is to consider rooming houses or granny flats and all of those exciting things that aren't as easy as they sound. And I've had a lot of interstate investors asking me about granny flats and second dwellings in Melbourne. You can't just put something up and expect that you can have a dual tenancy arrangement and that local council will be all right with it. In fact, in Victoria, they'll be all over you, and they might issue you a show cause and get you to pull it down if you haven't gone about getting the right permits. You've also got to factor in that unless you've got separately metered electricity and water, you can't charge your tenant for usage. So these false economies need to be taken into account. And when you're talking about low socioeconomic areas with really cheap rentals and multiple tenancies, just have a think about your lifestyle and your enjoyment when you're getting police calls on a Saturday night, because it absolutely happens. So I think that the risks associated with going for cash flow properties need to be really well understood. And even if you've got a great cash flow property that looks like it will be attractive in retirement, it means that you're holding it for a long time to live off the rent. You have to remember that every 15 to 20 years, you probably need to put in a new kitchen and bathroom. Tenants are relatively rough on properties, and I'm generalising here, but I'm speaking from experience. You need to be providing something that's meeting minimum standards and not deteriorating so that you're creating even more work for yourself with maintenance costs. So you've got to think about these little properties that have depreciated so much over the many years. They're not worth very much at all. Then when you're sinking $60,000 into a bathroom and a kitchen upgrade every 15 years, that comes right off the bottom line. So I know I've just touched the surface with this. I could talk about it till the cows come home. The positively yielding properties, if they're not delivering you great capital growth, they can be a really false economy.
Yeah, great overview, Cate.
So on that note, we might wrap up here unless you both have anything to add. Thank you, Dave and Mike, for breaking down the truths and traps of negative gearing. And for our listeners, remember, goals first, tax second, and never buy based on a slick brochure. But don't go away just yet. Stay tuned for our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
I remember the last couple of elections, not the previous one, the other two where negative gearing was on the chopping block. Obviously, I spoke to a lot of people, and the people that had multiple property portfolios didn't really care whether negative gearing was there or not. But the ones that were looking at their first in property, or they maybe had one or two those were the ones that were going to be affected. It's just interesting that, when we had that big debate about how it, favors the wealthy are the ones that were just kind of saying, well, I don't actually really care. And if this does mean that investors exit the market, then I'll just jump in and I'll pick some other ones up. What I think people miss with the cash flow stuff is that when we talk about a yield, let's say it's a 4 or 5% yield, which is probably fairly good in Australia as an average at the moment, it's a gross yield, right? So those returns aren't actually that good when you factor in all of the costs. So cash flow is a tricky way to make money. It's much better, I think, to grow the capital growth in assets and then, sell them down and get better yielding assets like a commercial, or that maybe there can just be index funds that in net are actually better for you. The only way that it makes sense is the leverage. You're putting a small amount of money down, but you've got the upside on that huge amount. But again, that's a cash flow thing. It's a capital growth thing rather than a cash flow. So I think people, they really do need to understand that getting rich with cash flow is a very, very difficult thing. It's a requirement to get the mortgage strategy right sometimes, but the best investors are always focused on assets that grow in value.
At the end of the day, you've got to treat property like a business. You need to understand the numbers. You need to understand how the numbers change over time. And so therefore, like with any investing, that requires long-term thinking. And, don't chase shortcuts. Generally speaking, they're probably going to be too good to be true. Their shortcuts often are not going to pay off. So negative gearing is a tool, if you like, or it's an aspect of often when you invest in residential property, that means you will be running at a loss. So sure, it does provide you with some tax deductions, and that might be something that you're looking for because you haven't, enough surplus cash flow. But, that's just part of the overall picture. And ultimately, the strategy, as we've talked about here and Mike's, covered off on, is really you make the most money from residential property through capital growth. So you want to focus on capital growth predominantly, particularly in the early years. You might transfer to more of a cash flow focused investment strategy as you get later in life. And I think Mike might have said, commercial property is better for that, generally has higher rental returns than residential property. So, and also, getting your mortgage strategy right is very important here as well to maximize your tax deductions in the short term and over the long run. So look, get good quality advice before committing to any strategy, because if you make mistakes, it can cost you a lot of money because we're talking about such large sums when we're investing in property.
We've talked extensively about land to asset ratio. A high land to asset ratio can go hand in hand with great capital growth, provided that the location is right and the property is a good one. And we also know that high tax depreciation is opposing high land to asset ratio. So when your dwelling component is greater and you've got more deductions on hand because you've got a higher rate of depreciation, you've got a lower land to asset ratio. So everyone can do the sums there. There is a correlation.
Yeah, 100%.
That's a good one.
Well, on that note, I'll see you fellas next week.
See you next week.